Next, LAF, liquidity adjustment facility. So, this liquidity adjustment facility is based on daily infusion and absorption of liquidity on repurchase basis. So, nothing but to inject money into the market or to absorb money from the market, Reserve Bank of India will use this tool. Okay. So, what is the actual measure, that is nothing but availability of money in the market, will be known through this LAF, liquidity adjustment facility. Another quantitative tool is CRR. So, CRR nothing but cash reserve ratio. So, this cash reserve ratio at present is 6.25%. So, this cash reserve ratio is nothing but all the commercial banks are required to maintain a minimum reserve or nothing but average daily cash reserve with Reserve Bank of India. So, this CRR is not an interest rate, very important for examination point of view. So, the CRR is a tool used by Reserve Bank of India, okay, on the commercial banks to maintain the reserve within RBI itself in the form of cash. So, why this CRR is used? So, CRR will be used by Reserve Bank of India on the commercial banks, because whenever the commercial banks are in problem, okay, or in bankruptcy etc. situations, the Reserve Bank of India will provide this CRR back to the commercial banks. Nothing but on every 100% or 100 rupees, 6.25% of money will be kept aside by the commercial banks, okay, or nothing but deposit with the Reserve Bank of India without expecting any interest. So, this 6.25%, 6 rupees 25 paise of each 100, okay, will be put aside. If it is 1 lakh, it is 2,050, okay. So, 6,250 will be kept aside by the commercial banks within RBI under safety lockers, and the RBI will not provide any interest on this CRR, okay. So, this ratio will be fixed by the Reserve Bank of India only. A minimum of 3% and maximum of 15% can be fixed by Reserve Bank of India. Means for each 100, 15 rupees or 15% can also be fixed by Reserve Bank of India. So, it is used whenever Reserve Bank of India feels that commercial banks are having excess liquidity or excess money, okay, so that it can absorb money from commercial banks to Reserve Bank of India only, okay. So, this CRR and SLR, now it is SLR, both CRR and SLR are nothing but reserve ratios. So, statutory liquidity ratio, which is now at 20%, okay. So, earlier this was at 20.25%, now it is decreased to 20%. So, statutory liquidity ratio is a ratio which is maintained on NDTL, net demand and time liabilities basis. So, nothing but a minimum portion of assets, okay, of bank, maybe cash, nothing but these current assets, maybe cash or gold or government securities, will be maintained within themselves, within their headquarters of banks. So, these money should not be lent back, okay, to the people on interest basis. Means of every 100, CRR is fixed at 6.25% and SLR is fixed at 20%, nothing but 6 plus 6.25% plus 20%, it is 26.25%. This 26.25% will be kept aside, okay. So, once the banks gets money, this money will be kept aside as a reserve money, which is used during crisis. If the banks are a crisis, then it can be used, Okay, so cash or gold or government securities. So in this proportionate, the money will be kept aside. Okay, fine, and the remaining money out of 100, 26.25%, if it is taken out, 74.75%, the money which is available with the bank, they can use that money for lending, or they can use that money for maintaining the banks, okay, rents or rates or employees salaries, etc., etc. Okay, following, and the remaining will be, okay, lent to the public for profits, nothing but interest. Okay, so SLR is nothing but statutory liquidity ratio, the ratio of liquid assets to demand and liabilities. So CRR will be maintained by Reserve Bank of India, and SLR will be maintained by commercial banks at their headquarters. For example, Andhra Bank headquarters in Hyderabad. Okay, fine, in Hyderabad, the reserve money in cash, in gold, in government securities will be maintained. Okay, following. If it is State Bank of India, its headquarters in Mumbai, okay, it's fine. So its SLR will be maintained in its headquarters only. So this is what. So in the examination point of view, the examiner will ask you in confusion mode. Okay, CRR by Reserve Bank of India, SLR by commercial banks, but it is being fixed by RBI itself. Okay, next, qualitative methods or selective measures. Okay, so apart from quantitative measures, the qualitative measures of Reserve Bank of India includes ceiling on credit or margin requirements and discretionary on interest rates. Okay, so these qualitative measures are fixed by Reserve Bank of India in order to balance the demand and supply, okay, based on the credit creation or margin requirements of commercial banks, as well as the interest rates to be fixed. Okay, so a separate committee will be there, okay, in order to discuss on this qualitative measures. And next key point is controlling of inflation. So what is inflation, which we come across on daily? Okay, so in our daily life, inflation we find in the newspapers, it will be seen in the news also. Okay, due to inflation, the market is being declining, the rupee is being depreciating. Okay, the supply of money cannot be controlled. So what is this? Inflation means, inflation is nothing but general rise in prices of goods and services. So if we understand the meaning of inflation, if anyone asks what is inflation, it is nothing but general rise in the prices of goods and services. So price increase or increase in the prices of commodities is called inflation. And what is the meaning? Broadly speaking, okay, inflation is broadly understood as general rise in prices of goods and services year on year. Okay, so inflation is a complex phenomena. It's a macroeconomic phenomena, okay, associated with money supply and currency values. Okay, so and the current inflation is 2.33%. And who is the regulator of inflation? So inflation is being controlled by Reserve Bank of India. Okay, so inflation is regulated and controlled by Reserve Bank of India only. So on daily basis or weekly basis or on monthly or quarterly or half yearly and annually, okay, inflation is being monitored and controlled by Reserve Bank of India. Okay, fine. In coming episodes, we will be learning about inflation also. So what is inflation? What are the types of inflation? So how it could be control inflation, etc., etc. And as of now, we will be learning about Monetary Policy Committee of 2016. And this, as we learned that, okay, monetary policy is being formulated and implemented by Reserve Bank of India in order to maintain the price stability and also control inflation. And now in the year 2016, from September onwards, Reserve Bank of India along with the Government of India has constituted a committee which is called Monetary Policy Committee. Okay. So, as per section 45(z)(b) of RBI Act amended 1934, a 6-member empowered committee is being constituted by Government of India and RBI. Earlier, Reserve Bank of India was the only sole authority to control inflation. Now, to control inflation as well as to monitor the monetary policy. But now it is the Government of India also, okay, taking a part, okay, with the help of Reserve Bank of India to look after the monetary policy and the working of banking and the controlling of inflation and to stabilize the economic growth. Okay. So, this MPC committee, Monetary Policy Committee, consists of one chairperson as well as 5 members. Total, it consists of 6-member panel. Okay. So, here we look who are the chairman and members of this committee. So, chairperson of this MPC Monetary Policy Committee is Sri Urjit Patel, who is nothing but Governor of RBI. So, who else will be the Governor of RBI? Will be ex officio chairman of MPC committee. So, as of now it is Urjit Patel who is the Governor of RBI. So, he is the chairperson of MPC also, and MPC is very very important for examination point of view, because after nearly after 50 years these things were being changed. Okay. So, it becomes very important. So, monetary policy apart from traditional tools, okay, has changed to upgraded one. Okay. So, with the help of Reserve Bank of India and Government of India, both have come together to look after monetary policy here since September. So, it becomes very very important. So, who appoints them, who is the chairman, who are the members of this committee, what are the main objectives of this committee, what are the challenges are kept, okay, before this committee becomes very very important for examination point of view, and you will be getting nearly 5 marks, okay, from this section itself. Okay. So, coming to the members, 𝗧𝗦𝗔𝗧 is the in charge member of this committee, who is nothing but Deputy Governor of Reserve Bank of India, and 𝗪𝗓𝗻 is the financial expert and officer of Reserve Bank of India, is also a member. Okay. So, here an agreement is there that monetary policy which is being monitored by RBI and Government of India consists of 3 people from RBI, 3 people from Government of India. 3 people will be appointed by GOI and 3 people will be appointed by RBI itself. Okay, fine. And the people who are appointed by the Government of India are Sri Chetan Gupta, who is a professor of Indian Statistical Institute, Mumbai, and Phani Dua, he is the director of Delhi School of Economics, Mumbai, and then Ravindra H. Dholakia, who is the professor in IIM, Indian Institute of Management, Ahmedabad. Okay. So, these are the empowered panel of monetary policy. And what are the factors affecting monetary policy nowadays? Okay. So, there exists a non-monetized sector. So, like we see organized sector and unorganized sector is there in the economy. So, this unorganized sector is non-monetized sector. Okay. So, the Government of India is trying to bring this unorganized sector in the market also. So, if a proper channel is being set, so automatically this non-monetized sector will also be brought under organized sector, and excess of NBFCs. So, non-banking financial companies or non-banking financial institutions are very huge in India, like you see example microfinance institutions. Okay, so MFIs, microfinance institutions will work in village levels, taluka levels for mobilizing funds from the people, as we see chit funds, okay, in the villages. Okay, so when we think of village level or at home level, we will be thinking about chitties, okay, chit funds. So, it is unorganized actually. So, these due to this what happens, So it will affect the organized sector also. So existence of unorganized financial market. So this is what, so microfinance institutions at village level is unorganized financial market. If something goes wrong, or else if this company goes, if this small chit fund company goes for insolvent, automatically the people will be addressing to the court, okay. So or else they will be addressing to the NABARD, which will work in rural areas, okay. So and this money which is supplying in the market will not be appeared actually, it will not be seen in the economy. So there is a huge market in the huge niche market in the rural economy, okay, which is being circulated within the people at the village level or in the rural level, but which is not being monitored, okay. So monetary policy committee is also looking after this, okay. And sometimes what happens is the government of India's fiscal policy and RBIS monetary policy lacks coordination, okay, in predictions of economic growth or in taking the actual statistics. So both coordination is also affecting the monetary policy here. And moreover, you see in India we follow the financial year from April to March, 1st April to 31st of March, we follow it as a financial year. But World Bank, IMF or any other country's monetary policy, they will be following the calendar year, okay, as annual financial statements. So in such case there will be a mismatch of predictions over the growth. So that is why sometimes you see RBI's growth rate is projected at 7% and finance minister's growth rate is projected at 7.5% or 8% even, and World Bank projects at 6% and IMF projects at 5.5%. So these are the difference of predictions we follow. So same thing happens in India too. So monetary policy and fiscal policy lacks coordination. So this is a major challenge for the MPC as of now, okay. So 2017. And when it comes to the conclusion of monetary policy, so here we are giving you a very simple tips to understand inflation, okay, and effective tools by Reserve Bank of India, okay, in order to monitor the monetary policy, okay. So the flow of funds, you see regularly it happens from Reserve Bank of India to commercial banks, from commercial banks to the public, and public to market, which will affect on PPP, purchasing power parity, okay. Here PPP means purchasing power parity. In economy there are two meanings for PPP. One is purchasing power parity, the other one is public private partnership, okay, in case of industries. But when we speak about inflation, it is PPP means purchasing power parity. Next, supply of money and the demand of the product and the increasing in the price of the product, which will affect on inflation or even deflation also, okay. For example, you see if this formula is remembered by you. So as a central bank, Reserve Bank of India will lend loans to the banks. If the banks are having more money with them, they will lend money to the public. If public are having more money in their pockets, their purchasing power parity will increase in the market. If they start purchasing more and more products, example, if the demand of mangoes will be very high in summer, demand of woolen cloths will be very high in winter, okay. So these products supply will automatically decline because of demand. So automatically what happens, it will project on the prices of the product. If too much price is increased, automatically inflation comes into picture. If inflation is very high, okay, so trade declines, transaction declines, and the recession follows. So, inflation is a very dangerous point in any country. So, it is being controlled by the government of India with the help of RBI. So, how come Reserve Bank of India controls? If RBI increases the bank rate or repo rate or CRR, SLR, automatically banks do not get loans from RBI. In fact, if reverse repo rate is increased, the banks will lend loans to the Reserve Bank of India, instead loans to the public, isn't it? So that the public will get less money in their hands, and their purchase power parity will come down and the supply increases, demand of the product comes down, automatically it will affect on the price. If price declines, inflation will be under control. If too much price is declined, it is called as deflation. So, therefore, inflation is controlled by maintaining price stability and to boost up the economy, and the economic growth can be achieved. So, this is how the inflation or price stability is maintained by Government of India through various quantitative and qualitative measures. So, in this chapter we have learned about what are the key policy rates of Reserve Bank of India, how it is being used.